Global share markets were hit by the jitters in overnight trading, and that jitteriness was evident across the board. We saw real pressure on those previously glamorous software stocks and software as a service stocks, but the US markets all fell across the board, with the NASDAQ down by about 1%, Dow Jones leading the losses, down 1.6%. And that was a real contrast to the action that we saw in the Asia Pacific region yesterday, where things were much more positive. And in fact, we saw a huge bounce in the Hang Seng, up 2.5%. Now, despite those falls in US shares, Australian share futures finished the overnight session in positive territory. And that's because there was a rush to safe havens. We saw the US 10-year bond yield rally once again, back down to 4.03% from recent trading levels around 4.25%. That's a big move in bond markets. But we also saw strong support for precious metals, with gold up 2.5% and silver up more than 4% in the overnight trading session. And it's that support for those metals and support generally across the commodity complex that probably pushed the Australian futures for the share market into positive territory. So we've got a bit of a mixed day coming up, with those negative leads from overseas offset to some extent by the composition of the Australian share market, and looking like, despite those negative leads, we might have a positive day today. But it was a very tough day for US stocks in overnight trading. Datadog was down 11%, CrowdStrike down almost 10%, AppLovin down 9%. So some very big falls in those previously much loved stocks. Now, in many cases, they're giving up gains that are fairly recent. In other words, gains that they've made in the last 6 months or so. But nonetheless, the percentage drops are quite significant. And it's clear that fear is on the rise. The volatility index is up to 21. Now, 20 is generally seen, 20% is generally seen as a bit of a line in the sand for the volatility index, or the fear and greed index. And a move over 20 indicates rising fear amongst investors. And combined with that support for gold and silver, and a lack of support for cryptocurrencies, with Bitcoin slipping below 65,000 in overnight trading, it does appear there's very much a risk-off flavour to trading in the US, and we could see that spread around the globe. Earnings season continues to rattle on. Here in Australia, we've heard from Woodside this morning. Some investors likely to be disappointed. Despite record production levels, Woodside reported a decline in profitability, largely due to the realised prices that it's selling its oil and gas at. We knew that the price for oil and gas was lower over the period, and we're always likely to see a decline in revenue at Woodside. But the market reaction today will let us know how investors see that decline, whether or not it was reasonable given the market conditions. After market today, we'll hear from Light & Wonder, the poker machine manufacturer. Then tomorrow, the supermarket giant Woolworths will report earnings as we roll through the busiest week of the Australian reporting season. But dominating investor thinking this morning is that meltdown in software. And a number of analysts and investors asking, is it time to buy the dip? And the reason that question is popping up is pretty reasonable. Year to date, the US software sector is down 27%. Remember, in many cases, software stocks peaked in October or November. From their peaks, they're down more than a third of their value. In Australia, we've seen falls for around 15%, but it's been called an indiscriminate hammering in some quarters, in that there seems to be a panic about it. And there's also some elements of double-sided thinking, I would suggest here, in that some are arguing that software stocks have overspent on artificial intelligence, while others are arguing that artificial intelligence will replace software. Now, these are contradictory positions, but the fact they're being raised at the same time goes to show how sour sentiment is at the moment towards those software stocks. And having boosted so many stocks on the potential for AI to improve efficiency in their business, we're now seeing a reverse impact, where fears about the decimation, particularly software businesses, is really weighing on the sector. Now, Jensen Huang, the founder of NVIDIA, has said that artificial intelligence will elevate, not replace software. And that's a very positive take that the market seems to be ignoring at the moment, but there is potentially a case there. There are a number of investors who are wary about catching a falling knife, At the moment, the falls in many of those software stocks are very steep. And at this stage, the momentum is clearly negative. So some investors will be happy to step up to the plate based on their view on valuation right now. Others might be waiting for a more stable share price and be prepared to give up some of the earlier gains to see that the massive downward momentum has slowed. However you approach it, there's certainly starting to become a valuation argument in a number of these software stocks. And it's interesting to see a number of the Magnificent Seven stocks now with a PE multiple on last year's earnings of around 20 to 25 times. It's an extraordinary position given how stretched we have seen PE multiples, particularly in that subsector. To see them coming back to much more reasonable levels is very interesting. Now, it's quite possible earnings could be revised downward, particularly if there is a real impact from AI on some of these major stocks. But if it isn't, we've now got a value argument in the Magnificent Seven stocks. And that's the first time I think I've ever uttered that sentence. We are expecting some lower earnings as an impact of AI starts to spread, but other software stocks are likely to gain, particularly those who can realise production efficiencies. So at this stage, the software spend in the US is up 15% for this year and could well be revised upward as we move through the year. A number of analysts are arguing that big software stocks are at a clear discount, and it's a sector-specific call to those software stocks, but nonetheless, something a lot of investors are looking at right now. And at the top of that list and the top of our watch list today is Microsoft. Its share price is down 20% year to date, more than 33% from its peak in the fourth quarter last year. In valuation terms, Microsoft is at its least stretched level in at least 3 years. It has a lower PE for the Magnificent Seven. Revenue's up 17% this year. Cloud revenue was up 38% at the most recent result. And of course, Microsoft has the OpenAI deal that so many analysts are very keen on. In July, Microsoft shares hit a high of $555. They're now trading at $384 as it closed this morning. A number of analysts have got a short-term buy. A lot of the valuation targets for Microsoft are between $430 and $678. In other words, well north of where Microsoft shares are currently trading. Now, we can't deny that downward momentum. There is certainly some pressure on the stock, but at the moment we're getting to a valuation argument and a number of investors wondering if the 20% year-to-date fall in Microsoft shares is enough for them to start buying again. While we're in the tech sector, we're looking at IBM, and IBM is catching headlines this morning for all the wrong reasons. Its share price tumbled another 13% overnight. It's now down 24% year to date. Now, the argument around IBM has to do with the fact that it administers a lot of mainframes that still use a software language or computer language that was first developed in the 1960s called COBOL. And the threat here is that the AI group Anthropic, with their Claude software, now, or their large language learning model, will be able to replace COBOL coding very quickly and efficiently, and undercutting IBM's mainframe consulting business. Now, that really has started to spook IBM investors. That 13% fall that we saw in the share price overnight adds to recent pressure on the share price. Now, IBM's revenues for 2025 are actually up 8%, but it's all about 2026. And IBM was forecasting a further 5% gain in its earnings this year, but of course, that came before this news. And the potential for downward revision here is very real. Investors clearly getting ahead of any analyst revisions downward of earnings by selling right now. And looking locally for the third stock on our watch list today, we have Scentre Group. It's reported this morning and reported strongly, and it's one of the largest shopping centre retail real estate investment trusts. It is a flagship report this morning. Now, its funds from operations, the like-for-like comparison favoured in the sector, shows gains of 5% for 2025. The funds from operations up to $1.12 billion. It had a statutory profit of $1.8 billion. its occupancy rates are 99.8%. In other words, Scentre Group is full, and January sales were up 5% on the previous corresponding period. So unsurprising, a number of analysts in the Moomoo community have a buy rating on Scentre Group. A target price range is around 15% upside from the current close at $3.79 for Scentre Group.